Well, hello, everyone, and welcome to a new series brought to you by the Tax and Legislative Affairs Committee of CFMA. I am Rhonda Huismann, and I'm the committee chair. I'm also a construction consulting partner with Crowe LLP. And I'm being joined by Jeff Kummer. Jeff is a managing director with Tax Policy Group in Deloitte's Washington National Tax Office. Welcome, Jeff.
Thank you.
Thanks for being here today. So today, in the first of this series, Jeff, I think it probably makes most sense as we get started here and kicking this off and setting up for future calls that we'll have and updates that we'll have for the members, that you start off and kind of just bring us back a few months and where we all got started here. Was that back in August when a lot of this talk started, and maybe bring us up to how we got to where we are today.
Sure, Rhonda, happy to do that. And the way I try to think about this discussion that we're having in Washington as it relates to tax policy is really sort of what I call the 4 Ps, because it's about process. In Washington, everything is driven off of process. It's about proposals. What are those key individual and business related tax proposals that are on the table and are being discussed, decisions about them being made even today. It's also the prospects. Where do we think all of this ultimately ends up? And it's the politics, because again, in Washington, everything comes back to that political element and that sort of cross-sects with all of the different policy discussions that we have. So as this is the first webcast here to sort of set the stage for what's happening on tax policy, provide a little bit of context and background for how we arrived at this point, and then maybe a little bit of color commentary on what we potentially expect going forward. We really have to kind of go back to August because a couple of developments occurred back then, which we are now seeing the ramifications of play out. And back in August, both the House and Senate approved a budget resolution. Now, a budget resolution in and of itself is a non-binding document. The President of the United States does not sign a budget resolution into law. But what that document does do is it establishes a couple of things. One, it sets the parameters for a legislative proposal that congressional Democrats are very focused on that would include both tax and spending components. The other thing that it does is that it sets up a process, it's all about process, referred to as budget reconciliation. And that process is significant because it allows a party, particularly important in the Senate, it allows a political party to pass legislation on a single party vote. In other words, when you look at legislation, typically you need to get 60 out of 100 votes in the United States Senate in order to bring legislation onto the Senate floor, amend it, ultimately vote on it and approve it. Today, we have 50 Democrats in the Senate and 50 Republicans. And this is a tax and spending discussion that no Republicans are really interested in supporting. And so how do you figure out how to get to that threshold where you can consider it? Budget reconciliation is the answer to that. It allows you to pass legislation on a simple party basis. You only need 50 votes. Vice President Harris could be a tiebreaker if necessary in order to get this across the finish line, if that's what it takes. And so again, it really allows the majority party to pass legislation just requiring a simple majority rather than that 60 vote threshold. So that budget resolution in August set the stage and set the parameters. It set a top line spending number of about $3.5 trillion that congressional Democrats would focus on trying to meet both through tax cuts and spending increases, largely offset with tax increases on upper income individuals and on businesses. And so that sort of fast forwarded then to September 15th, the House Ways and Means Committee, which is the tax writing committee in the House, actually approved a $2.1 trillion tax increase package with about $1 trillion worth of tax revenues focused primarily on upper income individuals, another $960 billion or so focused more on corporate entities and international related tax changes, primarily impacting US multinationals and inbound companies. Another couple $100 billion focused more on information reporting, so-called tax gap measures as a way to bring in additional dollars. So $2.1 trillion, this is September 15th, with the idea that it would be offsetting a significant portion then of about $3.5 trillion in tax cuts and spending. Other savings to be found then both through a spending policy. One way is to allow Medicare to negotiate script drug prices with pharma companies. A lot of discussion around dynamic scoring, assuming that legislative changes will result in direct GDP growth in the economy, and then scoring increased tax revenues being collected by Treasury based on that GDP growth. So tax a component, a significant component, but not just the only piece of sort of arriving at that number. Well, all of that sort of fast forwarded to the end of September because you had this House and Senate budget resolution. Speaker Pelosi had established that the last week in September, the House would vote not just on a budget reconciliation package, but also on a bipartisan highway infrastructure package that passed the Senate 69-30 back in early August. And that Speaker Pelosi said that she promised moderates within her Democratic caucus that they would get their vote on that bipartisan highway bill. But she also promised more progressive members who were concerned that if those moderate Democrats were to vote for the highway bill, they may be less inclined then to support this tax and spending package. So Speaker Pelosi also promised progressive members in her Democratic caucus that they would get a vote on budget reconciliation. Of course, we managed to get to the end of September and frankly, just were not ready to hold that vote on budget reconciliation. President went to Capitol Hill on October 1st. He explained to moderate Democrats in the House that they were not going to get their vote on a highway bill yet, and then explained to progressive members that that $3.5 trillion number was going to have to get significantly smaller because there are moderate Democratic senators. Remember, the Senate is 50-50. There are moderate Democratic senators who have established a top line number that is much lower than $3.5 trillion. In fact, Senator Manchin from West Virginia is at around $1.5 trillion. So you have significant differences in overall scope and overall size that Democrats on the Senate and the House side within the progressive and within the moderate factions within those caucuses are addressing. And so that is sort of fast forwarding us into the debate and the discussion that we're having today.
So that's really fueling, keeping things ever, maybe more interesting than normal in some of the debates that are going on, although I'm sure it's always interesting from your seat. But thank you for that. I think that's helpful and bring it together in a concise way for those that have been trying to follow this through the media and across that period of time. So thank you for that. I'm wondering if you can go just a bit deeper in some of those kind of key business and individual proposals that that you're seeing and playing out here.
Sure. So what we have is we have one vision for what tax increases would look like, and that's what was approved by the House Ways and Means Committee. Of course, we're expecting that the Senate will put its own fingerprints on this whole process at some point as well. But when we go back to that House Ways and Means Committee approved tax bill, on the individual side, we see an increase in the top marginal rate. So today, taxpayers paying a 37% top rate. Now you have a Ways and Means Committee approved package that would bump that up to 39.6%, returning it to the top rate that existed back in the 1990s, as well as from January 2013 through 2017. There's also an additional surtax on ultra high net worth taxpayers. So if you think about 39.6% as a new top rate, then you factor in another 3% on top of that if you are a taxpayer who happens to have $5 million or more of modified adjusted gross income in a given year. There's also a proposal to increase the long-term rate on qualified long-term capital gains and qualified dividend income, moving it from the rate that exists today from 20% up to 25%. Don't forget, however, that if you're focused on this, you most likely are also paying net investment income tax under current law. So really 25% is more like 28.8% when you think about that. And that has an effective date that is set by the committee at September 13th, 2021. So any gains recognized on a sale of an asset, for example, after September 13th would be taxed at the new higher rate according to this proposal. If you have a gain that is recognized prior to that, then you'd be taxed at the lower rate. If you have a written binding contract on a transaction in place prior to September 13th, then it would be that lower rate treatment would be preserved as long as you closed on that deal and closed on that transaction prior to the end of the year. So those are the two sort of big proposals that probably generate the most discussion. There are other individual provisions. There's that 199 cap A pass-through deduction that is often important in the pass-through space. The Ways and Means package would phase the value of that deduction out, and once a taxpayer hits a joint filer hits $500,000 in income, they would no longer qualify for that deduction anymore. There's a change to carried interest, which is that preferential income that's often important in private equity and in the hedge fund space. There is a current law 3-year holding period. You have to hold that for 3 years before you can get that lower long-term capital gains treatment. That would be extended to 5 years, along with some other modifications there as well. There is a current law provision that goes after excess business losses. It's a limitation on those losses. It is in place. So it's effectively a tax increase that has been in place now for a few years. It is in place through the end of 2026. This Ways and Means bill would make that permanent, other than allowing that to sunset and taxpayers potentially getting some relief from that provision. And then in the estate and gift tax area, what is not here in this Ways and Means package is some form of stepped up basis, an income tax recognition event at death or a gift. But rather it takes the current law exemption and tax rate amounts for estate and gift tax that otherwise would sunset at the end of 2025 and accelerates them into 2022. So for example, if you are thinking about planning for your estate as an individual, the lifetime individual exemption today is 11.7 million, double that for a couple. If this were to become law beginning next January, that would go down to about 6 million per person. So a significant difference potentially there. On the business side, there is an increase in the corporate statutory rate. So those that are organized as corporate entities, C Corps, there is an increase in up to 25%, up from 21% today. And by the way, on these rates discussion, Rhonda, you and I will come back to this in a few minutes and discuss some later, some of the more recent developments potentially. But that corporate rate increase is a big one. There's a lot of international changes that really more are on the multinational side, both outbound and on the inbound side. There's one other change I might mention is related to executive compensation. That's there's a current law $1 million corporate deduction cap for certain highly compensated employees, the CEO, CFO, and next 8 highest compensated employees within an organization. That is a total of 10 covered employees, but that's not really effective until 2027. It would accelerate that to next year. So there's some business related changes that are out there as well as individual related tax increases. But I also should mention that that Ways and Means Committee bill included a significant number of tax cuts and tax incentives as well. So it's not all just tax increases being talked about in the context of this discussion. There is an expansion of the work opportunity tax credit. The new markets tax credit is made permanent. There's additions to the historic rehabilitation tax credit. So again, you think about those, within larger cities, all those historic buildings that are being refurbed and refreshed. New markets tax credit, all that development and investment in inner city communities and rural communities, that all kind of, part of that investment package. And there's a lot in the clean energy space as well. So companies that are investing in, the investment tax credit, production tax credit for wind or solar or geothermal. There's a lot around electrical transmission, refueling property, electric vehicles. There's about $240 billion worth of 10 years worth of investments in the clean energy sort of space that are also included in this package as well. So there's a lot here to kind of think about and pay attention to at a more granular level for taxes.
Yeah, absolutely. And, highlight that there is some good and some good that actually, would apply to some of the contractors and certainly the membership, CFMA. It seems like, most of the chatter I hear, like you had mentioned, is around the individual rates and the capital gains rates. But even then, early conversations were much worse from that perspective, and where the current increases look to land is a lot better than had capital gains, for example, gone to ordinary rates, which was originally some of the chatter that was happening, right? That was on the table. So that's all great. The 199A, certainly that's something that our members should keep an eye on as they go forward as well, because I think we have a lot of pass-through type entities as members too. So But good. Well, thank you for running through the proposals there. And I think from a committee standpoint, I think we do plan on doing some deeper dives into that too, and some of those proposals as they, become law. So I guess next steps, Jeff, what are you seeing currently going on? I know there's a lot of things going on right now, and maybe an update on that, and then looking forward.
Sure. So there's been a lot in the press the last few days. There's a lot of tensions that within that Democratic Party that are looking to be worked out here. And you have all of these different sort of tug of ropes around not just tax, but other programmatic policies as well. So these different questions, again, more progressive members, they might look at sort of the overall size of the package and say $3.5 trillion in total spend is about the number that we like. More moderate members, Senator Manchin, as I mentioned, is at about $1.5 trillion in total spend. So remember that Senate, as I mentioned before, 50-50. So every single one of these Democratic senators has maximum leverage on every single issue. And as long as Senator Manchin says around 1.5, or maybe a little higher than that, perhaps, but around 1.5, that means the overall size and the scope of this package has to get smaller than perhaps the $3.5 trillion number we were talking about before. So again, you have different ideas. Do you look at a lot of these spending programs around healthcare expansion of Medicare, expansion of Medicaid, community college tuition, universal pre-K, all of these different reforms around paid family and sick leave, all these things. Do you try to do a lot of these, but only temporarily because you only have a certain amount of money? Or do you try to do a few programs, but do them well and do them on a more permanently funded basis? These are the questions that are being worked out right now. In the energy space, there's a lot in the clean energy space. There's a lot of moving the U.S. towards emission standards in 2030 and clean climate goals. And of course, the president at the end of this week is going to Scotland to discuss climate. And so, do you move in that direction, or but remember, do you also have fossil fuel producing state senators like Senator Manchin from West Virginia or Senator Tester from Montana? May have a different view, want to protect those jobs, those carbon intensive jobs that are in their states. Taxes, this is the big question now. Do you follow a Ways and Means blueprint, or do you take into account Senator Sinema, who has not publicly stated, but has it's been reported in the press that she is not supportive of an increase in the corporate statutory rate, individual top rate, or capital gains rates? Well, if you take those three proposals out, that's where a lot of the revenue is to finance a lot of this package. So where do you go directionally as tax writers on Capitol Hill to find those revenues? Now we're starting to talk about perhaps a billionaires type tax. So a mark-to-market mechanism, an annual assessment on unrealized gains for people who have $1 billion or more in assets effectively. There's talk around on the corporate side imposing a book tax, a book minimum type concept for certain large companies to ensure that they pay a certain threshold of tax to the U.S. Treasury. So the minute you start pulling these other sort of rate ideas away, you have to start thinking about other proposals to raise revenue. And that's really kind of where we are today. As I mentioned, the president leaves at the end of this week. That bipartisan highway bill is still sitting out there. Moderates are clamoring for a vote on that by the end of this week. October 31st is the day that the current highway authorization to spend money expires. It was temporarily extended at the end of September for 30 days. And so there's a desire to just have that bipartisan vote in the House and have President Biden sign it into law. But again, you have more progressive members who are saying, still waiting to see where budget reconciliation is. So if there is an agreement that is effectively set, it doesn't have to be statutory language or legislative text, perhaps. Perhaps it just needs to be a document that says we're going to spend this much, we're going to spend it on these programs, and we're going to raise the money that we're going to spend on those programs from these things. If congressional Democrats in the White House can agree on a framework that looks like that by the end of the week, we might see that vote on that bipartisan highway bill by Friday. And that would set us up for November, really, and middle November, even maybe going into December, where they could then pass through the House and Senate this tax and spending package. But still a few things that have to be determined and decided. And that's going to take a little bit of time, I think, to work through the system.
Okay. So it could be a big week ahead of us here. switch.
Could be a big week. It's only Monday.
Only Monday. I guess any other final thoughts today? This was a great getting us up to speed and bringing us through kind of where we're at with the current environment. Anything I guess else you'd want to add here before we let the listeners go? And I will tee up what's ahead of us too in terms of these the series here that we're doing.
Mm-hmm. Yeah, I think it is just a matter of sort of keeping on top of the press, just to sort of see what's happening as developments warrant. I think we'll come back and update these. But right now we're in that stage where congressional Democrats are really trying to figure out what they want to spend money on, how much money they have to spend, and then how do they want to raise that money to pay for it. And those sound like three very simple sort of questions to answer, but they're obviously much more complicated than that. So
absolutely, much more. Well, it's going to be interesting to see how this all plays out. I'm excited to be on this journey here with you, Jeff, and thank you. I invite all of the members listening to keep tuning in, keep an eye out. These will be posted on LinkedIn as well as in the Connection Cafe and available on the website. And so we hope that you tune in, share these with your colleagues, and hopefully it'll be a great source for you to keep up with everything that's changing in the tax and legislative affairs area here in the next couple of months, which I am certain is bound to be a nail biter as we kind of see how this all plays out. So thank you, Jeff, for today's information. And I look forward to being back with you soon, whenever that may be here in the next week.
Thank you.
Thank you.